Okay, so in this video what we're going to look at is how to find the expected current price of a stock which has a constant rate of growth. So here's our problem. What is the expected current price of a stock which paid a dividend of $3 per share yesterday if the dividend is expected to grow at a steady rate, of 6% per year, and if the rate of return required by shareholders is 15%? So if we look at this particular scenario, what we have is a stock which paid a dividend yesterday of $3, and the dividend is expected to grow at a steady rate of 6% per year, so that is a constant rate of growth. If it is a constant rate of growth, then in that case this is a constant growth stock. So to find the value of a constant growth stock, the value today of a constant growth stock is going to be equal to D1, a dividend a year from now, over KS minus G, where KS is the required rate of return by shareholders and G is the rate of growth. So if we look at what we've been given here, the $3 of dividend they paid yesterday is actually going to be D0. So D0 is equal to $3 per share. And then it specifies that we are expecting the dividend to grow at a steady rate of 6% per year. So G is equal to 6%. And the required rate of return by shareholders is 15%, and that's KS. So in this case, what we're going to do is we're going to need to plug things in. But the formula asks for D1. D1 is the dividend a year from now. So if we sketch out a little timeline here, time 0 is today, and in this case the company paid a dividend of $3 basically yesterday. So if they paid a dividend of $3 yesterday and the growth rate in the dividend is 6% per year, then we need to find the dividend at the end of the first year. So to find that, all we need to do is take D0 times 1 plus the growth rate to get D1. Or we can substitute that into this formula over here. So in that case, what we'll do is we'll do our formula. So our expected price today is equal to D0 times 1 plus the growth rate over KS minus the growth rate. Well, if we substitute in, D0 is what they paid yesterday in terms of dividend. So that's $3. And then we know that the growth rate is equal to 6%, so I'm going to put that in decimal form, so 0.06. And then what we have here is KS, which is the required rate of return. So again, putting that in decimal form. And then our growth rate is the 6%, so in decimal form, 0.06. And then if you work that out, we can see what the expected price of the stock would be today. So I recommend that you pause the video and work that out and see what you get. Okay, so if you worked that out, what you should have gotten in the numerator is $3.18. And then for the denominator, 0.15 minus 0.06 is 0.09. And then if you divide that out, you should have gotten $35.33 with the 3's repeating. So that would mean that what we would expect the stock to sell for, or the expected price of the stock today, the hat indicates expected, is $35.33. And that would be the expected value of this particular constant rate of growth stock. I recommend you try some other examples and see how you do.